with these first words of introduction, the topic of the day, just transition. As I highlighted, we need to look at the just transition in the broader context of ESG, SDGs, and beyond. We need to literally understand that a just transition, first and foremost, is of course linked to the so-called low carbon green energy transition. But it goes far beyond this. It is interconnected with areas that involve, and I will show that afterwards, climate, ecological, and social/stakeholder specific issues. And it is something that the investor community, together with many important NGOs, such as the World Benchmarking Alliance, such as Finance for Tomorrow, and the PRI, as well as, academic institutions such as the LSE Grantham Institute, are actually developing to provide further insights in how we can connect and intersect the challenges ahead, especially as we are now understanding much better, looking at the pandemic far and beyond, that this interconnectedness of so-called systemic risks, may they be linked to health and well-being, may they be linked to the broader social and stakeholder context, ultimately cast their shadows fast forward. And ultimately, a just transition, therefore, requires companies, investors, and the wider value chain to ensure that workers, suppliers, consumers, and communities are not left behind in the equation. And the aim with a just transition assessment is to mitigate the risks faced by these different stakeholder groups to ensure that they can benefit from the opportunities that are presented by the low carbon transition. And why is this important? Transition is a precondition for the delivery of what we say the low carbon or green transition. It ensures, in the same time, as I highlighted, that the general economic and social stability and resilience factors and ultimately economics are in place. And it provides and protects and enhances a company's and an investor's social license to operate. Because again, what happens at a company level ultimately ends up also at a portfolio level when we look at assessing and then integrating specific companies into, for instance, equity portfolios. And transition risks and costs are being lowered when companies plan for a just transition. This is an interesting field of study. Again, I can refer as a follow-up here to multiple pieces of research, not only from academia, but also from industry. And I should highlight that some of the coalitions we now form part of are actually specifically looking at the direct links between risks, costs, performance, and opportunities management in the context of a just transition. And for all of you who'd like to find out more why, and not only what and why, but who is actually involved, a quick note, the European Commission is obviously just launching a social taxonomy. The consultation has just been completed. And a major chapter in this social taxonomy, beyond describing the social criteria and factors that you've heard of, I'm sure quite a lot today, it has an entire section on the just transition, the mechanism that's also supporting the Europeans' Green Deal. And then last but not least, of course, again, World Benchmarking Alliance, we co-lead as ODDO BHF Asset Management, the investor coalition, collaborative investor coalition on the just transition. We're working in the moment on mapping out the different type of stakeholders in working and supporting a dedicated benchmark for collaborative engagement. And also we are, together with Amundi, co-founders of the Finance for Tomorrow initiative around the just transition collaboration. Finance for Tomorrow, of course, a leading NGO predominantly operating out of France, but also in Central Europe. And we are working with them on defining, what I said, the metrics, the areas, the criteria, and the research that we can utilize for collaboration. And last but not least, and I will say a few more words about this in a moment, we are also supporting and are part of Climate Action 100+, one of the leading investor coalitions to work towards the consultation and then the proposed approach for the so-called just transition indicators that these benchmarks will include and literally work on over the course of the next 18 months. In regards to the just transition efforts, it's important to understand some of the frameworks that are currently already in use by investor groups and capital markets, as well as financial services at large. I've deliberately chosen a framework that is quite known to some of you, the so-called TCFD framework, and now the TNFD framework. TCFD looks at climate-related physical and transition risks. TNFD very much focusing and centering on biodiversity risks. Both of these frameworks, again, have already or have been working on or are in the process of working in defining the different type of economic financial risks and potentially other associated risks further downstream in relation to portfolio impacts and of course credit risks when and where climate change in particular, but also increasingly biodiversity and ecosystem challenges, extinction losses are concerned. What has not yet happened, and this is why I'm showing this here as well, but which is a trajectory to better understand how social implications might over the long term lead to business disruption. Clearly, we have seen this already in collective bargaining efforts, for instance, strikes, but where they also might lead to asset destruction, productivity and operational losses, the reconstruction and replacement needs for certain areas, such as businesses. And of course, when and where there might be an increase in certain activities, also leading to other efforts further downstream, may they be linked to stranded assets or an increase in the context of a green transition, of course, an increase in prices when and where energy is consumed. And I know this is currently in the energy prices here in the UK, the energy crisis in the UK, a very hot topic. But also beyond the economic impacts, which might sometimes be harder to define for the vast variety of different social topics and issues, it's also the ambition to look further downstream around the financial impacts. And as I highlighted, where we are now is from an investment management standpoint to actually look more closely at portfolio impacts and at specific risks such as climate value at risk and related tail risks that ultimately, ideally in future, might be also expanded to assessments for ecological transition risks as well as just transition risks. So more on this spectrum, not yet developed, but definitely to come. And this means, again, taking a step back, where are we realistically with some of these transition efforts? I mean, I highlighted the Climate Action 100+'s work. This is where a lot of the collaborative engagement between investors and corporations, but also other stakeholders, has really, built a great momentum for the entire industry, where we have seen major shareholder resolutions being planned, mapped out, developed, and ultimately implemented. And when and where we have seen in the entire sector, the fossil fuel industry shifting and aligning with the so-called transition targets of getting a net carbon neutrality, for instance, towards 2050. And this net zero carbon neutrality emissions target is something that's well reflected over certain time horizons in the Climate Action 100+ benchmark. But why I'm showing this is that there's also something already foreseen, which I briefly touched on, which is the so-called Just Transition Indicator, a mechanism that will actually allow more social factors to be assessed. Again, it's all about the stakeholder consideration and the impacts for workers, communities, consumers, and suppliers that might be affected by a company's decision and actions to actually transition. And this is hence so important because, as we know, in many different regions in Europe, Eastern Europe, for instance, there are still dependencies, heavy dependencies on the fossil fuels industry. And if we look broader and beyond Europe globally, and we had these discussions yesterday at the World Benchmarking Alliance's group that actually now looks at the just transition efforts, we of course discussed other states such as South Africa, Australia, and emerging markets in general that have still heavy dependencies for economic prosperity and growth. And we just heard about Africa, that ultimately depend also on the fossil fuels industry in order to meet their social, their stakeholder, their societal targets. And this is something we need to all monitor and obviously develop jointly very closely to ensure that when we transition, there is a fair transition for all. And with these few words of introduction around how we define and classify a just transition, I thought it's also important to set the scene for how investors are engaging on the issues. We know not everyone on this call today is necessarily an investor. Many of you might also be linked to corporations, NGOs, and other stakeholder groups. So I've deliberately chosen a bit here, a quick discourse to highlight to all of you how we define active ownership, and in particular, the engagement and dialogue part within what is classified as active ownership and the use of the rights and position of ownership to influence the activities or behaviors of investee companies. And that, by the way, is a quote here directly taken from the UNPRI, who of course has active ownership as one of their 6 principles for responsible investment. To also highlight, because I'm being asked very often, okay, beyond the portfolio construction reality, which uses commonly processes and procedures such as screening and integration of ESG factors, maybe the considerations of how to construct portfolios in the context of different approaches, fundamental, thematic, and increasingly impact. Where do you see active ownership, and what does that really mean? So that's why I've also highlighted under the whys that active ownership is already a market reality. We have seen this as one of the major strategies here reported on the right-hand side as part of the Global Sustainable Investment Alliance's report. This is a snapshot of the 2018 report. We see a similar picture for the latest report, by the way, that was issued in early 2021 for covering the spectrum of 2020. But active ownership is more than that. It's becoming also mandatory. You know, we have seen explicit guidelines around stewardship codes and for ESG labels that all mandate not only more transparency and certain exclusion thresholds and so on, that have specific guidelines around when and where the opportunities and the long-termism and the influencing, the good stewardship around active ownership is concerned. And again, I highlighted the work of the PRI and many asset owners in this space. But ultimately, I would also like to showcase to all the investors here in the room, looking at the academic study that's very often quoted by Dimson and Caracas here, again on the right-hand side, that there is a financial benefit for long-term investing when you also undertake side-by-side an active ownership approach. And again, I should highlight that very often the impact investment approaches are now running side by side with a defined active ownership strategy. Because again, if you want to influence over the long term, engagement and other means, I will show them in a second, for engagement and other means such as proxy voting, shareholder resolutions, and other specific means under active ownership can really help with establishing long-term results and positive change trajectories. And that brings me here very quickly to highlight again the different tools that ultimately investors have at their hand when applying an active ownership strategy. I've highlighted again engagement here that we utilize. We also utilize proxy voting. We've been involved in specific shareholder resolutions. We have been involved in obviously collaborative engagement and individual engagement efforts. But it's also interesting to see that the lines are getting increasingly blurred. We have, as sustainable investors, the full toolkit at our hands. Sometimes mistakenly, people then refer to us as activist investors. This is, again, a slightly different category and a different ambition where you are up and foremost trying to influence specific activities, and you use the full toolkit of these active ownership efforts to get your specific activist aims to the fore. I mean, we really see the need to ensure that we highlight and flag and then follow up on the specific trajectories, positive change trajectories we want to see, especially linked to climate, to the ecological and the just transition. We wouldn't classify ourselves as activist investors. And that brings me to the last part of my brief intervention here to show you, as I promised, of how an active ownership strategy would look like and what the ambitions are if you look at the climate transition, the ecological transition, the just transition. Again, I've highlighted there is an area that we already use proactively to construct portfolios, to screen, to integrate ESG, to build fundamental and thematic portfolios on the trajectory also in looking into impact. And side by side, we have been setting up this active ownership effort here with the help of also other organizations and investors to define where we want to focus. And for us, the climate transition is all about the energy transition that I highlighted, decarbonization, and ultimately reaching net zero carbon goals, also for our portfolios. The ecological transition side by side, and we have launched a dedicated thematic fund in this area as well as obviously engaging on these topics here at large, is to support natural capital and ecosystem services, the biodiversity and the species protection areas. And then last but not least, just transition is tying these different ends of a climate transition with impacts linked to an ecological transition together. And we look more specifically of how well companies are managing over the longer term, the areas that are tied in with economic growth and prosperity as I highlighted. And we look specifically for areas such as equality and inclusion, for human rights and labor standards, for good human capital management practices, supply chain management oversight, and community engagement. And we do these type of engagements over different time horizons. So just to show you here again, when we look at an individual engagement that we set up with a company, we try to really follow through with our own proprietary ESG methodology and model to ensure that a company that is maybe in the 10% of companies that potentially could be classified as laggards or learners, that we help them getting over the next threshold. And we have set different targets here for 1.5 to 2 years. We know and we understand that not all targets can be achieved in a short period of time. So we've ultimately left room. Sorry, I think we have some interference.
Caroline, could you just, oh, you are muted. Brilliant. I was just double checking. Sorry, Martina.
No worries. We ultimately are leaving room for then other options in order to ensure that we are not moving from engagement to divestment in sort of year 1 and 2. So we are moving a specific topic linked to the climate transition, for instance, ecological, and now going forward, social and stakeholder / just transition topics over to a collaborative engagement agenda. That means we have identified groups that we can work with, which also include other investors, to get our joint aims and ambitions across. We are using proactively proxy voting and voting decisions at AGMs to ensure that we also have a clear trajectory on the key topics. I've highlighted shareholder resolutions in the past, for instance, linked to the climate transition, that we can actually get right in front and across the table. And then as a last option and last resort to say, we also keep divestment, of course, as an option. But this is really in the rarest cases, because we think when we lose a seat at the table, we no longer have the means to engage and ultimately to change. And knowing that we need to close here, I just wanted to show you on the next couple of slides very briefly the process that we follow to showcase that an active ownership approach, of course, cannot be undertaken in isolation. We work very closely with the portfolio managers as part of a broader investment team effort, a collaborative effort also internally, to identify key issues, to prepare for company meetings, to continue with a long-term dialogue, and then to ultimately monitor and report, and to concretely formulate next steps. And some of this information, of course, you can find also in our dedicated engagement, active ownership, engagement and voting policies and reporting documents. And then last but not least, if you'd like to find more concretely about some of these areas or criteria and KPIs we are using to ultimately map out our specific efforts versus existing frameworks, such as UN Global Compact, the Sustainable Development Goals and other frameworks, then I'm showing you very high level how we're interconnecting and intersecting issues related to the climate and ecological transition, and of course on the stakeholder capital and the just transition efforts.